You know, fractional shares have totally changed the investing game, letting pretty much anyone own a piece of the biggest companies out there. But, and this is a big but, this revolution comes with some pretty serious hidden risks. So today, we're going to pull back that curtain and see what's really going on in the fine print. Okay, so take a look at this number. Not too long ago, that was the price for one single share of AutoZone stock. I mean, for a lot of us, that's a month's rent, right? It's a perfect symbol of a market that, for the longest time, just felt completely out of reach.
But what if I told you that you could just sidestep that massive price tag? Well, you can. You can get a piece of that action for as little as $5. But the real story isn't just that you can do it. It's about how it all works behind the scenes and, the hidden trade-offs you're making along the way, maybe without even realizing it.
All right, let's dive in. First up, let's talk about the core problem that fractional shares were actually created to solve.
For decades, the message was pretty clear. Sure, you can invest if you've got thousands of dollars just lying around. If you wanted to build a properly diversified portfolio, you needed a ton of cash just to buy one share of a few different great companies. This huge barrier to entry, it was a massive problem.
And that right there brings us to the solution, the ability to invest by the slice. Seriously, this is where the game was completely turned on its head for the everyday investor.
So what are we really talking about here? Well, fractional share investing, or FSI, basically flips the old model upside down. Instead of asking yourself, how many shares can I afford, you start thinking, how much money do I want to invest? It sounds simple, but it's a really profound shift.
In the process, it's about as straightforward as it gets. You just decide on a dollar amount, let's say $20. Your broker takes that money, checks the current stock price, and does all the math to figure out the exact fraction of a share you can buy. And just like that, boom, you're an owner.
And this is the promise, right? This is what brought millions of new people into the market. All of a sudden, you had access to those big, high-priced stocks. You could build a diverse portfolio with just a handful of dollars, and every single cent in your account could be put to work. It made powerful strategies, like dollar-cost averaging, super easy for everyone.
But you knew there was a but coming, right? With every great promise, there's almost always some fine print. And honestly, this is the part of the story that most people just skip right over.
The sales pitch is fantastic, no doubt. But the catch? Oh man, the catch can be a real headache. Let's say you find a new brokerage you love and you want to switch. Those whole shares you own? Yeah, no problem. They can move right over. But all those little fractions of shares? They're stuck. They can't come with you.
So why? Why can't you just move your little slices of stock? Well, it's because the system itself, the industry's plumbing, it's kind of old school. It's a system called ACATS, and it was built for a world before fractional shares. It's literally designed to only handle whole numbers. 1 share, 10 shares, 100. Fractions, nope, doesn't compute.
And here's where it really stings. Because your fractional shares are stuck, your old broker is forced to sell them. They just liquidate them. And that sale, well, it triggers a capital gain or loss, creating a tax event that you are absolutely not planning for or ready for. It's a sneaky form of lock-in that can end up being pretty costly.
And believe it or not, the limitations don't stop there. As a fractional owner, you generally don't get to vote in company elections. Also, your broker is the official owner of record. They hold the shares in what's called street name, which just means they're registered to the brokerage, not to you directly. And you can forget about pre-market or after-hours trading. Fractional trades are almost always stuck to the standard market day.
Now, this is super important to know. Not all fractional share programs are the same, not even close. I mean, the differences can be huge. Look here, Schwab limits you to just S&P 500 stocks with a $5 minimum. But then you've got Fidelity, which just blows the doors open with over 7,000 different stocks and ETFs for as little as $1. And Vanguard, they stick to their own funds. The point is, you really have to look closely at what your specific broker is actually offering you.
Okay, so we've talked about this structural stuff. Now let's get into a major risk that you, the investor, really have to get a handle on: the tax trap.
So when you go to sell some of your holdings, the IRS has this default rule. It's called first in, first out, or FIFO, and it's exactly what it sounds like. The government just assumes the shares you're selling are the very first ones you ever bought. Okay, so why is this such a big deal? Well, think about it. If you've been buying little bits and pieces over time and the stock price has been going up, your oldest shares are also your cheapest shares. Selling those first under the FIFO rule means you realize the largest possible capital gain, which means, you guessed it, you get hit with the largest possible tax bill. It is the exact opposite of what you want to do. But, and this is a really important but, There is a powerful solution. It's an accounting method called Specific Share Identification, or SPEC ID. Most of the big brokers offer this, and it lets you completely override that FIFO default. You get to be the surgeon, precisely choosing exactly which little tax lots you want to sell.
And this is how you really take back control. With SPEC ID, you can choose to sell the shares you bought at a higher price, which minimizes your gains. Or you could strategically sell shares that are at a loss to cancel out other gains. That's a cool trick called tax loss harvesting. So here's the key takeaway. When you sell, the single most important setting to check for is specific ID. It is literally the difference between you controlling your tax bill or letting a default setting control you.
Now, all of this, all these little catches and complexities, they haven't gone unnoticed. Regulators have been paying a lot more attention, and it's pushing all of us into a brand new era of transparency.
Up until now, the true volume of fractional share trading has been like a ghost in the machine. I mean, the public data feeds have been rounding trades up or rounding them down, completely hiding the reality of the market. But that is all about to change, big time. We're talking about a new mandate for hyper-precise reporting.
This timeline really shows the whole journey. We're moving from a past of inaccurate, messy data to a very near future of total clarity. The key date to circle in your calendar is February 23, 2026. That's the day all this high-precision data goes public, giving regulators and the rest of us a crystal clear view of this part of the market for the very first time.
So what's the big takeaway from all this? Well, this quote just nails it. Fractional shares are not a fad. They are a permanent, fundamental part of the financial system. And the fact that we're seeing more and more regulatory oversight just proves they're here to stay.
Look, fractional shares opened the door for you. They gave you a seat at the table with the giants. But now you know the deal, right? You know about the transfer restrictions, the tax traps, and the rights you give up. So the real question isn't just about the market anymore. It's about you. Knowing all this, how are you going to invest differently?